Welcome back to Fresh Economic Thinking. You're with Cameron Murray and a special guest today, Mike Fellman, all the way from Puerto Rico to discuss housing economics. Thanks for coming, Mike.
Hi, Cam. Nice to finally be on your show after following your work for a long time and your blog. Mike
Uh,
Fellman. I'm a economist. I live in Puerto Rico, as Cam pointed out, and I'm speaking up in the housing debate, which is a very non-controversial topic these days, both in Australia, Canada, United States. Um,
maybe we should start, Mike, with understanding how you like. We met on Twitter as people do these days when discussing their intellectual curiosities. And sort of when we started conversing, when you started writing about all the problems out there with the housing analysis, right? The housing debate seems to be missing some economics. What what was it? Was there a particular event or commentary or argument that really triggered your interest and got you into it where you had to say, hey, that's wrong. That doesn't make economic sense to me. How did it begin for you?
well, I was I was at a organization called Freddie Mac, which is also but that's its nickname in the United States. It's the Federal Home Loan Mortgage Corporation, and since it has federal in the name, that's a big clue that it has something to do with the U.S. federal government. And so I worked there. It's one of two entities that are owned by the federal government, and they securitize 80-90% of US mortgages. And so they're heavily, the US federal government is heavily involved in the mortgage market. And what loans don't get securitized by these entities are, there's home loans for veterans, and then there's some home loans for low and moderate income borrowers, and that's all government backed. And
So
so I
what
worked
does
there
that
for a
mean?
while.
Maybe before we continue, we could just what does securitizing a mortgage mean? And so what is a non-securitized mortgage, for example?
Well, a non-securitized mortgage, the one thing that will surprise your Australian listeners is that most home loans in the United States are fixed rate.
Mhm.
And so there's not a lot of appetite for banks, which have demand deposits, which can be withdrawn at any point. Someone goes to an ATM uh, or sends money on a payment app on their phone or withdrawn from their bank. So they can't hold a 30-year fixed rate loan on their books.
Mhm.
And so there's really traditional lenders like banks have no appetite for those kinds of loans, but the government had a public policy objective of providing that kind of product to the consumer at large because it protects the borrower from swings in interest rates, and therefore having their payment rise above what they can afford. So it's rent control for homeowners. I think if you've pointed out on other
Yeah.
podcasts and articles, um, and so the government could just make the loans directly, but instead what they do is they bundle them all up and then sell them off to private investors.
Can I,
But
we're
but the
getting
government still
distracted.
guarantees the credit risk there for them.
So a bank goes and creates a mortgage for me when I go and get it. And then it says, I've got this liability to Cameron with his mortgage. Um, and I don't really, I'd rather have a more liquid liability. So I'd like to sort of sell this loan.
Yep.
Is that what happens? And Freddie Mac buys it off the bank? Is that,
Buys it off the bank. Yep, we'll buy it off the bank, and then they will create a huge pool of them, and then that becomes what's known as an agency MBS agency, just because it's an agency of the federal government,
Mhm.
and that will be sold into the marketplace. And basically, the way that these instruments are priced is that it still has it's backed by the full faith and credit of the U.S. government. So
Mhm.
why doesn't it have the same yield as like a treasury bond? Well, because there's the embedded prepayment option where
Okay.
the underlying borrower can sell their home or they can refinance. And so that
Right.
because there's that prepayment option, it's priced very, very similarly to like callable debt, which is there's a few corporates who issue callable debt, but that's just a bond that you can prepay. And
Great. So private banks make these long-term loans, but they'll only do it because they can push the risk onto the federal government who'll buy them.
yes,
Otherwise, they would want variation in the interest rate, the more the
exactly.
borrower's paying, because
Because
the
their
mm,
liabilities, the rate they have to pay on deposits is variable.
that's right. And so
If
the US government created this thing that says we're going to take mortgage risk out of the banking system so that we can get home owners to borrow at a fixed rate for a long period because we think that's going to
yes,
increase home ownership. Wow.
yep, and
And what
reduce the
was,
risks of home ownerships.
yeah, that's true. And what was your job there? So, were you off
I was
selling?
actually, I was in, no, I was in I had two jobs there. First, I was in the office of the chief economist. Uh, and that we didn't really have much to do directly with the operations of the enterprise, but we kind of just produced commentary on the housing market. And this was way back in 2014, which the U.S. housing market still had not fully recovered from the great financial crisis, where we had a 30% decline in home values in 2009. It was mainly concentrated in large cities, but so some places didn't see any home decline, but there was huge swaths of the country that saw humongous home declines. There was
Mm.
places in Florida where prices declined 90%. It's like insane, right? So there's lots of variation, lots of variation
Oh my goodness.
across the country, but nationwide average of a 30% decline. And obviously, if you're in the mortgage insurance business, that is horrific for you. Um, and so it was a challenging time for Freddie Mac and its sister organization, uh, which is also backed by the U.S. government. But yeah, it's very topical to be producing like commentary on the housing market. But back then we were worried that like people were talking about they want home prices to go up because home prices were so low that um, it made no sense to build because the replacement costs, the cost to build a new home was like two or three times, maybe four times in some areas, what existing homes were selling for. And obviously, a new home is brand new; it can command a premium in the marketplace. But hey, if you can get something that costs a quarter as much,
Mm.
it's gonna, that's gonna be much more attractive to most buyers, even buyers with a larger budget. They're gonna say, let's buy this existing home and
Yeah.
just do a remodel and
Or buy four of them.
yeah, exactly. And so there's still like this huge thing. I went back and I watched, the 20, again, I don't mean to be too US centric, but in the 2012 US presidential election, it was Barack Obama who was reelected versus Mitt Romney. And there was a presidential debate. And Obama's on the stage, and somehow a housing market comes up. And Obama says, oh, yeah, it's really good news that housing prices are going up again basically. Like, can you imagine, in the environment we're in now in the US or in Australia for someone to say, hey, it's good that home prices are rising. Um, but the time is that, home prices
Well,
have declined so much and just as a signal for the broader economy,
I can
they
imagine
thought it
that
was good.
because, yeah, most politicians do say because if two-thirds of the electorate own homes, they don't
That
want to
too,
say.
yep.
Even now, it's pretty hard to get a politician to say that. And there was controversially a New Zealand housing minister said that, and then the prime minister had to backtrack and say, no, we don't want that. And so
Yep.
great hilarity and confusion
I think that happened in
ensued.
Canada too. I think the same thing just happened in Canada. Like the housing minister in Canada said, uh, you know, or something like somebody said it was either I don't think the prime minister said they corrected him, but like
Mm.
someone suggested, maybe a member of parliament suggested that they thought home prices should decline, and then like the housing minister said like, oh no, like people's investments must be protected.
Well, that's the classic. I call it the symmetry of property markets in my book. So
Yeah.
let's continue your story. You're working at Freddie Mac. uh, 10 years ago. Um, what happened next, and how did you become this public commentator that I know now?
Well, I was at the IMF very briefly after that. And then I just went off into my own and started doing like my own investment deals in real estate. And because I mean I love investing and it interests me and I kind of fell into it by accident. It's just like I graduated with a master's degree in economics and like the first place that hired me was Freddie Mac. And then I just got into housing that way. It wasn't actually something I was terribly interested in graduate school. The reason I got interested in economics was because of the great financial crisis and I was very interested in financial markets. And obviously, this is other than the US government itself, this is like the bigger, Freddie Mac and Fannie Mae, which is like the sister organization, the government sponsors enterprises that are in the mortgage markets are like the biggest issuer of US dollar denominated debt. So they have a huge footprint in the financial markets. So I was more interested in working there because of that, but I got into housing because obviously they're connected to housing in a huge way.
Hmm.
I went on to the IMF briefly, and then I just struck it on my own and started investing in real estate and doing my own deals. And then I ended up moving to Puerto Rico in 2019. And I think you found me on Twitter maybe about a year ago.
Mm.
Uh, and so, but
Yeah. So I
I
found
started
you. You
commenting
start.
on housing,
Yeah, you
but
started a bunch of mega threads on Twitter. Sort of, it felt like you'd accumulated all these frustrations about the state of the
yeah.
commentary. Yeah. So what got you started finally
Well,
calling people out or calling out bad analysis in housing?
because I think that so obviously the state, like taxes, regulations, the state can have an impact on economic outcomes, right? But, unless you're talking about some state some area where the state has an overwhelming presence with their regulations. Like really, what you see in the marketplace is usually the market outcome, right? And yes,
Hmm.
there's some regulations on the side that matters that like, you know, uh, if you raise the cost of some sort of economic activity with some regulation that there's some cost, like minimum cost to comply with, you like slightly reduce the optimal amount of that good or services which is produced. But it's not like, it's not by some massive amount unless you have some sort of like highly interventionist economy like you see in like, Latin America in the 50s or something like that.
Hmm.
And so it just kind of started to, kind of annoy me, and that I just felt the commentary wasn't moving beyond like, oh yeah, this is, the reason home prices are high is just because of all this regulation stopping home production. And it just really didn't get to any of the realities that face the housing market of just, well, first there's a humongous premium to to land to location in any sort of real estate. And so there's plenty of places in the United States or in any country really where home prices are dirt cheap,
Mm.
even relative to incomes. But no one really no one wants to live there because they're undesirable locations or even places in my country where the job market is fairly strong. Like you can get a job, an entry level position for, 15, $16 an hour, and homes are selling for like 50 grand. That's completely affordable. Obviously you would need to have the down payment, but you can get a 3% down payment loan, through one of the government's lending programs. And so these are completely affordable homes. So why aren't people flocking to, the
Mm.
suburbs of Kansas City or, Tulsa, Oklahoma, you know, to buy homes there? And it's like, the people are upset that in a large cases, and I understand, people are upset that home prices are like very, very high in, New York City or Los Angeles or San Francisco. But again, these are, tiny, tiny strips of land and have that where these homes are hugely expensive. There's topological constraints. You can't sprawl out infinitely when you live on a little island or in a strip of land that's a peninsula. And so yeah, like I think that obviously if you lived there before and you've seen your rents skyrocket, I can understand why people would be upset with that. And there's social networks and there are people who don't want to get priced out of a community that they've lived in that used to be very affordable to them. I totally understand that. So with that proviso uh, out of the way, I would just say that, yeah, like I don't think it's like necessarily a surprising result that in private property markets, you would see places where homes are incredibly affordable, even relative to incomes, and places where they're very unaffordable because, they're just highly, highly desired locations and they're not making more land.
Yeah, like what you're saying obviously makes sense to me, Mike. And in fact, I get the feeling that your background in sort of pricing securities and understanding those financial markets, I think it's important actually because I don't know if you know Aziz Sundarji, who writes Home Economics,
Yeah.
a great website. I've had Aziz on before. He also has a background in bond pricing and financial markets, and he also sees property as similarly priced based on its financial characteristics. Right, the market's going to price that asset as it does all assets, and if high income people want to move to a location, they're going to sort of outbid each other until the marginal benefit of spending more money in that location is not worth it. And then the property owners in that location, the assets priced based on that and the tax settings and the prevailing economic conditions and so forth. So, would you say that a lot of the debate is on housing in that it just doesn't know what the price should be, doesn't have a theory of what the price of housing should be in a market economy? Or like, because that's where I sometimes get to, or do you have a different take?
I think that's basically right. I think that another big issue is that people think that there's like how do I want to put this? Well, I think there's two ways to think about there's like the price rationing way. Like if you assume there's if it did work, that there was some fixed number of homes, right, that could even be like created, right?
Mhm.
Let's say it's true that let's say that the regulations were so onerous that it capped the number of homes in a given area.
Right. Or we just banned
Um,
building homes for 2 years nationally or
yeah, or
something
something like
crazy like
that.
that. Yeah. Okay.
Yeah, I think that you would see something where it's like, yeah, home prices would just rise and go to the highest bidder, and that's like price rationing, right? But the reality is that it's not how um, regulations are working, and it's not a hard cap on homes. At the most,
Mm.
it changes the spatial distribution of homes within an area. That's the most onerous it is. Um, and so I don't think it even necessarily gives you fewer homes. I think it might change the spatial distribution of homes. And I think that gets back to the valuation. When you think about what makes a home valuable, well, there's two ways that you can think of it as just like, uh, it's an asset that could produce income as rents, right? And that's one reason the home is valuable. The other reason the home is valuable, and so that's like just purely asset market analysis of just, okay, how much rent does this produce a year and how much is it going to appreciate every year? And so,
Hmm.
and just capitalize that into the price, right? With some asset market equilibrium of like, okay, so what's, my risk of holding this versus other assets and its illiquidity and blah, blah, blah. And the other way it's thinking of homes, there's obviously hedonic or factors that I'm just hedonic pricing of just saying, hey, it's really close to a lot of amenities. It's close to, you know, got places where there's high paying jobs. It's close to transit if it's in a very dense area, so you can walk to the train station. All these things. Um, and so yeah, I just think that. there's not like when you think about how anything, any home, why like certain homes are incredibly expensive. It's like because they have all these amenities, like, close by. It's like New York City, to live in Lower Manhattan if you can, and walk to everything. And there's a tremendous demand for that kind of situation. And so yeah, the price is really high. And I think where a lot of the conversation goes off the rails is that there's this belief that, oh, well, we can just build it more densely, and that anyone who wants to live in New York, who wants to live in Lower Manhattan, can live in Lower Manhattan.
Mm.
But they don't ignore, they miss that there's tremendous costs to higher levels of density that are non-regulatory. And so you can build, the cheapest way to build a unit of housing is to build a single family home out in the suburbs. The materials are cheaper, the labor is significantly cheaper. To build, I don't know what the building material, in the United States, they use a lot of, lumber and drywall to build homes. Is
Same
that
here.
the case
Yep.
in Australia? Yeah.
Yep.
So like the Anglosphere is really the only place in the world that uses this construction technique. It's a relatively cheap construction technique. Um, but here in Puerto Rico, which is a U.S. territory, but we have hurricanes, so everything's made out of concrete. It's more expensive, but the home is more durable. But anyway, yeah, like the cheapest way is to build, low density homes out of lumber is the cheapest way to build. But then when you say like, let's add levels of density, well, that's going to require materials that are more expensive because you're not going to be, well, you can build an apartment building out of lumber, but the techniques is relatively new, and the architects I've talked to have said it's roughly a wash in terms of
In
the traditional
price.
building
Yeah.
modes.
In
Yes,
terms of the
the
cost. Yeah.
traditional, yeah, the traditional building modes of like, reinforced steel structures. And the labor costs you more because not only is that the labor is more skilled, it's more dangerous.
Uh,
Uh, think of the iconic photo
of like
of
Empire State walking
state
on the steel
building
girders
of
and
good. Yeah, exactly. I mean, those guys were making pretty decent wages for the time because it's a
yeah.
pretty dangerous job, right? So, um,
So you're sort of
and so
saying
all
that,
that all
yeah, the idea
all
that we
that
can
gets
build more
into.
densely cheaply is at odds with the economics of construction as
Yeah,
well.
because you have to get you're getting there's really fundamentally in real estate there's a price, and again this gets back to like maybe my background in securities pricing, but just there's a price, or there's a location, space, living space trade-off. And so what someone's willing to pay per square foot. Right. You want to think of per housing unit is not very informative metric because I mean theoretically you could build 2 by 2 pods and call it a housing unit and say it's incredibly cheaply. Would anyone purchase it? Probably not. Right. Like a 2 foot by 2 foot like tiny room that you live in. I mean, but you could theoretically construct those cheaper than you could, a house, right, or whatever. But so the price people are willing to pay per square foot is intimately connected to how close is this housing to desirable amenities. And so when you have denser modes of construction, for the reasons I talked to about the materials are more expensive, the labor is more expensive. The fact that it probably needs a bathroom and a kitchen, that's the most expensive part of the home. So that's like the lowest. Like you have to have a kitchen, you have to have a bathroom. Everything else is kind of negotiable, right? Um, and so, the price per square foot rises a lot the more densely you build. And so if the economics can work where it just says, hey, even though it's in Times Square or in Lower Manhattan or wherever it is, inner Sydney is that like the
Yeah.
a desirable part, and that people just aren't willing to pay, what it would cost to construct something that dense, right, per square foot. Like they're not going to pay, $2,000 a square foot to, even to live in inner Sydney, or even to live those are just, it's just too high. You can't go denser. Um,
Well, that I think they will. So that's 20,000 a square meter. So that's 2 million for a 100
maybe
square
I don't know
meter
what the
dwelling. So in
yeah, I
inner
don't know what
city
the I
Sydney,
don't
that's pretty normal pricing in
I
Aussie
don't know
dollars
what
at
the I don't
least.
know that the price is. I'm just throwing out
Yeah, I know what
numbers,
you're
but
saying. So you're basically saying that there's this weird conflict, and I've tried to articulate this before that um, you can't have high density in cheap places
yes.
because it's got to be expensive to justify high density. So there's this weird thing that, oh, we're going to build all this high density and make prices cheaper. You're like, but if prices are cheaper, no one wants to build high density, right?
Yeah.
Like,
Because the
and
high density, people have to be willing to pay the high cost per square foot because it's so much more costly to construct
mm,
housing at those higher levels of density. And so unless you have like, really high rents per square foot, or high condo prices per square foot, like, the economics don't work.
so
And so
so yeah, go.
you can in theory increase, when you think about like just carrying capacity, how many people could actually live in this like area, if we built to maximum density, maximum allowable density. You almost never see almost any housing market, any area where there's actually like they've actually hit maximum allowable density, because it's just incredibly costly to build dense housing. And so the market conditions have to be pretty favorable, even in areas where are thought of as very desirable. I talked to people in San Francisco, which is already one of the densest, like San Francisco, the city proper, is one of the densest cities in the United States. And it's 18,000 people per square mile. Don't ask me that in square kilometers. Um, but it is, um, uh,
People always tell me San Francisco should be denser. There's too many
yeah, they
small
always say,
buildings.
but the developers I've talked to have said that probably like net operating income for rental housing would need to rise 20% before they would even think about it being viable to build at higher densities right now.
Wow.
And that's just because and yes, they clap back with yes, the city of San Francisco is run by, very, very liberal politicians, like every big city is in almost the entire world, but especially the United States. And they put all these onerous regulations on things. But, at the end of the day, even, but, that's like still like, five to maybe in the worst case scenario, 20% of the cost of the project. And some of those regulations are not actually like complete nonsense. Like it's like stuff
Yeah.
that says like, some they count like municipal fees, like, okay, well, you have a sewer hookup fee, like that probably shouldn't be free, right? Um,
Yeah.
and there's fees to that, we don't have municipalities really, in theory, there's no reason they couldn't tax income, but that's, yeah, it's very frowned upon.
Mm,
They don't really have I guess they could, maybe coordinate with the state and federal taxing authorities, but very few municipalities have income taxes. I think a few have experimented with it, but they tax real estate,
yeah. Yeah.
is their main
So
source of income. And so they
I want to
have,
get into that, by the way, the taxing, but I want
sure.
to ask you another question before we move on to you. You've sort of raised 2 points there that the developers you talk to don't want to build in San Francisco till rents rise. So what's the deal there? Because we've heard they're going to build to push rents down, right? Which is a weird sort of story. But before we get into that and tax settings and things, on the building denser and the cost of regulations, there's this really sort of popular view out there that there's something to do with some building requirements in the US where two staircases are needed for certain buildings. Now, I've tried to zone out of that debate, but is that true? Is it only the fact that buildings over a certain height need multiple staircases that's sort of preventing the market from unleashing affordable, large three-bedroom apartments and all these other things I hear? How do you sort of make sense of those claims? Do they get anything right? Is it all wrong?
Well, I'm actually not, I'm not an architect, I should say. So basically, like, why is single stair is like kind of this weird obsession of the YIMBY movement, that they think that if we go with single stair, it's gonna, as you said, unleash all this building. Really, what as you point out correctly, what you could do in theory, and again, I'm not a design expert, but if you have a single stairwell, you could maybe build more larger, like you could build a building below a certain height with with larger units, right? But I think one of the things that this misses is that smaller units tend to again have higher rents per square foot, and so the developers just looking to maximize revenue. So they just want to say, they can't charge rent for really for the common areas, right? So
Hmm.
the people don't care about how big their apartment is, okay? And so the larger units there may be more total living space if you go with single stair construction. But I think there's a very good thread I saw about this that said that, compared to double stair um, with a bunch of studios to a single stair with large two and three bedroom apartments. And the thread said no, that actually it's optimal to build the two-stair building with the studios than the single stair with the larger apartments, because the studios, while there's less total living space because you have to make room for the stairwell and like the hallway,
Hmm.
it's kind of hard to visualize. The single stair is where you could go up one stair and then there's like a very small common area and it opens up into like multiple large apartments. And instead of like, the traditional dual stair where you have hallways on the end of the building, or not staircases on the end of the building,
Yeah.
and then a hallway down, and then these apartments go out like this. Um, and so he said this thread said that no, like actually the studios, there's less total living space, but because for a studio in one bedroom, the rent per square foot tends to be higher, that you would actually make more revenue with the dual stair design. So it's not necessarily like just assuming that this one regulation is stopping all of this building from being unleashed is also very optimistic. Now, I'm not saying it's nothing. I'm not saying that we should not say that if you want to build a small infill project that is, 3 feet high and has, large apartments and you want to do single stair, that's fine. But it's not, again, it's not a panacea that's going to unleash all this building. The cost savings are, you know, relatively
Yeah. It's pretty marginal, right?
well, yeah. Yeah, the cost savings are going to be, somewhat large for smaller projects, but for these large, highly dense uh, buildings,
Mm.
it actually probably makes more sense to go dual stair and build smaller units.
Yeah, yeah. I'm with you. And I mean, depending on how many apartments, you might want bigger stairs. I mean, if someone's moving furniture one day, um, everyone might be stuck there,
Yeah,
right? Like,
yeah, no, and there
because you can't get down the
and
stairs.
the safety issues. I have actually been convinced that sprinkler systems probably don't pass cost benefit analysis.
All
And
right.
those can be very expensive. And so the other risk for single stairs is that, there's if there's a fire in the building, that there's only one
Yeah.
egress, there's a single egress, single way to get out. Uh, and
Look,
so that's one of the arguments for dual stairs is you have to have two ways for people to be able to exit their apartments in the case of a fire. Um, and so the safety record of apparently of Europeans who have many more of these single stair projects is pretty decent, but for buildings that are, less than 6 stories. And I am basically convinced, I have been convinced that some sprinkler systems that are mandated actually do not pass cost benefit analysis. That yeah, there's some
Yeah,
uh,
right.
there is, it does make you safer in theory, but the risk of fire is so much lower in an apartment building because of what it's built out of, uh,
Yeah.
versus a single family home, which is the real fire trap because it's made out of wood. I have actually been convinced of that, but
Yeah, look, I mean, I take a pretty pragmatic view here. Like we do have a lot of experience building buildings around the world and having buildings burn down around the world, and sort of just do what works, borrow from other places that have tried different regulations or different materials. And look, it's fine, but I guess at the end of the day, yes, we should always incrementally improve our regulation to reduce cost burdens unnecessarily, and do things that pass, cost benefit. But as you say, unleashing construction is it's not that these are the constraints, right? It's not like we're butting up against, oh, we've got all these sites that we want to build right now, but only if we could build one less staircase, then we could start building
yeah.
straight away,
So,
and,
so
and we would
I
go as
think I
fast as we
actually don't
could.
even. I actually really don't like thinking in terms of like specific regulations. I actually just think of these things numerically because a lot of real estate guys and gals, we just work on spreadsheets, right? And I
Mhm.
think you mentioned you worked at a real estate firm at one point where you did like feasibility studies and you're like
That's
modeling
right.
all the cash flows and all this stuff. And, really, a big misconception I think that's in the discourse as well, and I did a large thread on this, is that you really need rising rents to
Mm.
make any sort of new construction rental housing project viable. And the reason is because it's kind of counterintuitive, but the rental yield of which is just the gross rent minus the expenses divided by the what it costs you to build to construct the property, all in, including regulatory costs, um, is just not very attractive on its own. In the US, historically, at least, is between 3% and 6%,
Hmm.
in
Similar
most
here. So,
markets.
so apartment yields on gross yields, so excluding ongoing costs in Australia, around 4.5%. So the
Yeah,
net's closer to 3%, right?
right. And so in order for you to take that deal, and like the last I checked, maybe the Australian 10-year bond is, I think, in the threes. Am I right
I
there?
don't know what the 10-year bond is, but you can get cash deposit accounts, savings accounts at the bank getting nearly 5% right now.
Fair enough. So, why would you invest in the apartment building at 3%
Gross.
if
Yeah. Yeah.
growth,
Oh, I'm sorry,
you know,
sorry. Four
if
and a half. Yeah. Three or
for
less net. Yeah. 2.5 maybe.
that, why would you invest in that? What would be your motivation? Well, the reason is because if you expect rents to rise, and that's
Mm,
not only going to mean more rental income for you, but it's also going to mean that that rental income is going to be capitalized into the price of the apartment building itself, and it's going to accrue to you as a capital gain.
right.
And without that factor, you can't really, and you have leverage, right? And so you can also increase your returns by leveraging, 3 or 4 to 1. Anything more than 4 to 1 is in the US at least is rare.
Hmm.
It's not impossible. Um, but you can leverage as well to make money. But really, unless you have uh, the increasing, and that's if interest rates are below rental yields, you can sustain leverage, right? Because
Yeah.
but without the appreciation that's being induced by rising rents, um, you really don't get a situation where it makes any sense to invest in either buying an apartment building or constructing one. And so the market is very, very cognizant of the
Mm,
incoming supply in any given market or the incoming deliveries, to use And I'm changing my word there because I like to use, I'm getting in the habit of using supply and demand very precisely, which maybe we can get into that in later. But
Oh yeah, I'm totally with you on that. So I
the,
call it the
the
rate of production, or
the rate of
deliveries. Yeah, it's a good
production,
one.
yes,
Yeah.
deliveries are the rate of production. Other
Mm.
investors are very cognizant of this, and
Mm.
they can look at permitting data. There's a million real estate
Mm.
business intelligence firms that are estimating how many units are going to be delivered in any given market or even sub-market. So like, the west end of
Yeah.
town versus the east end of town, and then the whole town itself. Uh, so that people specifically don't flood the market and say like, hey, we're going to build so much that rents actually fall, and then it's a disaster if you have an asset that is, 3% net, and then that net is going down, right? Because
Yeah.
you're
And this happens, right? This is a really tricky balance because we've got a few build to rent new buildings. So it's actually very rare in Australia to have an institutional investor own a residential building and invest, because individual investors get to deduct losses against their personal income. And so they
Uh,
can always outbid the
that
institution.
ended in 1986. In the US, that was fate. That ended in
Oh,
1986.
right.
It was a humongous blow to the real estate industry in 1986, where we had hyper accelerated depreciation that
Uh-huh.
was passed in 1981 when Ronald Reagan first came into office. The first thing he did was pass a major tax cut slash reform bill that so you could take 175% of the uh, straight line, I think it was 3% or 4%
Yeah, yeah.
normal
Yeah.
depreciation. And
4%,
so
yeah.
you could end up effectively taking 11% of the asset
Oh my
value in
God.
depreciation a year.
Wow.
Because
So you can take that
you
as
got
an
this one
accounting
point.
loss against your personal
Yeah, you
income,
could
even
take
though
as
the
your
cash flow was good.
and it was deductible against
Wow.
deductible against active income. So every single doctor, every single
Yeah.
lawyer every high income professional was investing in apartment buildings because and also the top marginal rate in the United States in that year was from 1981 until 1986 was 50% was the top marginal tax rate. And so it was an incredibly lucrative tax deduction. And to be, it was effectively a humongous subsidy on the real estate industry because it spawned a cottage industry where people
Mm.
would go out and they would sell these investment opportunities that were set up to create these paper losses so that
Yeah.
doctors and lawyers and airline pilots could deduct their these paper losses from their active incomes from their high salaries.
Yeah.
And yeah,
And save
it was a
50% tax. Wow.
you had a humongous apartment boom in the 1980s, despite very high interest rates. And one of the things that some pushback that I've gotten that I've said, we saw that we had kind of an apartment boom in the US from 2021 that lasted until 2023. And then as soon as interest rates went up, that you had a
Mm.
collapse so it also had to do with the fact that just rents flattened, right? The rent stopped going up. And so
Yeah.
you couldn't make projects work on the investment side. But interest rates were a big factor too, and people always slap back at me. They say, but yeah, interest rates in the 1980s were incredibly high, but it's like no, but also you had this
This,
insane tax
wow.
write-off that
Wow.
was
So we have a
creating.
similar industry here, of people selling off the plan apartments to high income professionals. They're essentially selling them a depreciation schedule, but ours is not so aggressive. I think, we have two depreciation options. There's a bunch of accountants out there maximize all this sort of stuff, and
Yeah.
sell to high income professionals. Now, top marginal rates nearing on 50% once you add in a bunch of stuff, you know. So 40 something percent. And so that's sort of part of the business model here still today. But that was a great explanation for the listeners who don't know that. But to get back to your sensitivity of new apartment builders, I guess my point was that when we saw these institutions build these large projects in Australian cities with 100 or 200 units, it actually took them close to 2 years to actually rent them all out without having to drop the rent significantly. And so, of course, they're going to be very interested in who else is going to complete their building in the same neighborhood at the same
Yes.
time. Because if there's 400 um, being completed that year, it's going to take you 4 years to rent them out without, pushing the rents down too much. And that's quite a big cost and a risk that you have to sort of eat. You can't change that, right? That's part of this big risky period of construction and renting up. So
Yes.
yeah, it's totally true what you say. I mean, one of my jobs was to look at what other projects were happening in areas where we were looking to buy sites because we don't want to just jump in and buy a site when everyone else is jumping in. Like, unless we think we want to bank it for later, if we really want to build something right now, we look somewhere else. And unless the market is extreme, right? Unless there's a huge rate of migration and movement there. So I just wanted to sort of back up what you were saying there with the Australian experience. So go on
Yeah, and so
about
I think
rent.
I think when you saw like everyone's talking, I don't know, like in the United States discourse, I think it's even gone international at this point, but everyone talks about Austin, Texas,
Oh yeah.
which is a this it's the state capital the state of Texas,
Mm,
and it is for many, many, many years, it was a sleepy little town with that had the state capital of Texas in it and nothing else. And so Houston and San Antonio and Dallas are these humongous cities, these very large cities in Texas. And Austin was a sleepy little town that happened to have the state capital. And that change has been changing really since 2010. The rental and real estate market has been on a very, very long secular upswing in Austin, Texas, and it's super accelerated into the pandemic.
hmm
And you saw home prices and you saw rents skyrocketing um, from like 2019 and 2020. And 2020 was kind of flat, but you have to realize that the US rental market was in 2020. Which was the first pandemic year, was very, very segmented and distressed in most large cities. Um,
hmm
and so you saw rents falling significantly in New York and San Francisco, in my hometown of Minneapolis, in all sorts of large U.S. cities. You saw rents like declining up to 20% in large cities. That's because of outmigration, because people were trying to avoid uh, the the contact, and also if you have social distancing rules, the point of living in a
mm,
city is, to be able to be close to everything and go to restaurants and do all this stuff. And so you saw huge out migrations from cities, and that caused rents to fall significantly. But Austin rents kind of were just flat in 2020. So it's actually the rental market did really well compared to other metro areas. And then in 2021 and 2022, you saw rents completely surge. Saw rents going up 25 to 30% in some cases in some neighborhoods in Austin for 2 years. And so, yeah, of course, with a rental market that strong, anyone thinks they can make money building an apartment building.
that's right.
Um,
Yeah, I mean, if your rent's going to be
uh,
going up 10% next year and 10% the year after,
or
then
20%
oh, was it?
or
Oh.
30%, or 20 or 30 or 25%. And I think, and yes, to be fair, it was a higher inflationary environment. And so generalized inflation was 9% in the United States. You saw rents rising by 15% nationally. But this was well in excess of what you saw in terms of
Mm,
rent growth at the national level. This was two times what was
wow.
happening in other areas. And the other key thing that people don't miss or that people do miss is that this wasn't the rent growth was actually you were up and above pre-pandemic levels of rents substantially. When you saw rent surging in New York in 2021 and 2022. That was getting back to where they were before the pandemic
Hmm.
because you saw rents collapse in 2020, falling by 20-25%, and then you saw 2 years of double-digit increases. And so that got things back to even.
Yeah.
And so your viability was basically from 2019 to 2020, end of 2022, you were like flat. It
Yeah.
was super volatile. So if you were an operator and you had high leverage, it was very unfun getting through 2020 if you had to make mortgage payments on your, apartment building. But you basically were back to even at the end of 2022. Austin, you saw flat rents in 2020 and then a massive, then you saw 22 years of 20% plus rent growth back to back.
Oh my
And
God.
so because you didn't have that initial collapse and then surge, you actually just had a flat line and then an even larger rent surge, even in the places that had collapsed and people where people returned to when they got called back into the office or whatever. Um, just set up this that with also, with interest rates at 0%, with the, long-term interest rates being the lowest they'd ever been in the history of the United States. Um, yeah, of course, you saw lots of interest in building apartment buildings. But it was driven by a humongous run up in rents, where it just made it look like, this is just a sure bet to build in Austin. And they overbuilt the sector.
Yeah, well, that's what I
And
wanted to
investors
ask you. Do you think that the new demand there was overestimated and essentially wasn't persistent enough to justify many of the buildings? And so,
Well,
in
ex
retrospect,
post.
many building owners would say, "Whoops, we did too much." Do you
Oh,
think
oh,
we'll be more
absolutely.
cautious
Ex
next
post,
time?
ex post, and all over the Sun Belt is what's on. We call in the United States the Sun Belt, which is really just the Texas, like the southern states, like
Hmm.
Florida, Georgia, you know, uh, all the way over to Texas. Um, those areas just really overbuilt. They saw a rents held up pretty well in 2020. And as people moved from denser to lower denser areas, the southern United States is much lower density than, most
Hmm.
big cities are in the north or in California, uh, which is the west, not the south. And so, as people left those areas during the times of social restrictions and social distancing and went to places that were less dense and had nicer weather, um, and they weren't going to the office and everything was remote.
Yep.
The rents there rose, and the growth was so strong in some places that investors overbuilt. And bubbles can form in financial markets all the time. And like one example that I use, and I'm not going to say who tweeted it because I don't want to pick on them, but it was a finance influencer who said, I lost $100,000 in real estate, and it was on an apartment deal, not on new construction, but on an acquisition in Austin. And they bought a 1990 vintage apartment building in Austin at a 3.4% rental yield.
Hmm.
And so incredibly low rental yield for the US, at least, because it's on the very low end of that 3 to 6% range. And the stuff that tends to be closer to 3% usually is closer to 3%, but it has some other advantage of that it's in a very large city where that's very high demand city that tends to have stronger rent growth, and it's brand new construction,
Mm.
right? And so, yeah, you're getting your 3%, but you're going to get almost no credit losses because it's only very rich tenants who can even afford to pay the rent that's going to be charged. And, you know, hopefully if the building is new construction, that it's not going to need a major repair anytime soon. So
Yeah.
you're not going to get the dreaded phone call of, the operator calling all the investors and saying we need more money. And so all the reasons why you'd have a low rental yield for those kinds of deals. But this was a 30 almost a 35-year-old apartment or 32-year-old apartment building, because it was 2022 when it was
Yeah.
purchased, built in 1990, of a rental yield closer to the very low range of rental yields, which you usually only see in the biggest
And
cities in the nicest areas with new construction building is, Austin, Texas, which again, I said 15 years ago was a sleepy little town that no one had heard of if they weren't from Texas. If you were from Texas, you knew it was the state capital, and if you were a third grader who was learning all the state capitals of all 50 states, you'd heard and got an A on the test and you knew where Austin, Texas was. And so to see a rental yield that low for a acquisition, not a new construction,
Yeah.
and not only just an acquisition, but also in what was, not considered a huge in-demand metropolis like, New York City or Los Angeles or San
So
Diego
are you trying
or
to say basically that that indicates there was a bubble of some sort there in
yes,
Austin?
and
There was a
so
local
exactly.
bubble. Everyone got caught up in the hype. Not only did people overpay for existing buildings, but one way to get in on the hype was to build new buildings at these low
Yes,
yields. And so I guess, my experience would say that when that happens, I mean, the next cycle, wherever it is, people will remember. And the next housing cycle, Austin will be a very calm, cautious market with less building, but also less
exactly.
price growth.
And
Do you
in
think
fact,
that's
the last
yeah?
time I think that's perfect. I think that's exactly right. And I think that thinking that a once in a generation investor air and financial bubble in the Austin real estate market is not going to be like basing your national housing policy on that and saying, oh yeah, let's just lift all these regulations. And to be fair, speaking of the regulations, is most of the Austin had tons of NIMBYism
All right.
and even through in 2020 and 2021 and 2022, and really the city council you didn't have like a full blown like quote unquote YIMBY city council until 2023 when the boom was already becoming a bust and starts were collapsing because interest rates had risen and rents had completely flattened by 2023, and so the bubble was already deflating when they started passing all the YIMBY ordinances. uh,
Mm.
and it didn't sustain the level of building. The level of building fell a lot, and is continuing to fall. Um,
So
there's
you don't think
debate.
the devil's advocate sort of YIMBY view would be like, oh, well, even if there's a boom and bust, at least the regulations allowed for that huge amount of construction during the boom, and prices will be cheaper in the long term.
Well,
Like,
well,
what do you
here,
make
here's
of that
here. Well,
story?
I don't. Okay, so there's a couple things there that I think are really interesting. First of all, the last time we had this happen, it was not in Austin, Texas. It was 30 years prior, and that was in Southern California, which is supposedly this huge YIMBY villain of, for your Australian listeners, and for listeners around the world, California is a very, very liberal state politically. It's voted uh, consistently for Democrats and for the presidential and local elections. And so there's a big, and people broadly on the left are more supportive of regulations. And so there's a
Hmm.
big kind of undercurrent or thing in the zeitgeist of just, oh, see those the liberals in California, they won't allow any building because they have the
Hmm.
onerous regulations. If we remove them, I would unleash the building. Well, the thing is California was still a very, very liberal state in the 1980s, but California was experiencing massive in-migration from the rest of the United States and internationally as well. In the 1980s, the population was growing. Uh, Faster, as fast as the population of Texas is growing today. And what did you have? You had a humongous real estate boom, building boom, where home prices were skyrocketing, and therefore builders were building like mad. And I had the chart. I can't. I don't want to. I don't know where I put it, but you had you know at Texas and California. On this chart, and Texas was building, or in California they were building 20 to 30 times the number of homes in the late 1980s and mid 1980s
Wow.
than were being built in Texas because, well, no one was moving to Texas and people were moving to California. California was the place to be in the mid 80s and late 80s. And of course, the bubble eventually burst, and there was a humongous real estate crash in California, and then the building stopped. And a home in Los Angeles, 1990 was basically the peak, and a home in Los Angeles didn't recover its peak boom value until like 2001 or 2002. Um, and
Wow.
so you had a huge run up, a ton of building, and then a period of long decline where building slowly recovered, um, but it never regained. It never regained its prior peak because you never had the market conditions that where home prices and rents were rising so rapidly that investors were flooding in to
Mm.
to try to get in on that.
Am I right that Houston also had an 80s boom driven by oil expansion and then a big bust as well? And so for all the talk of Houston being the liberal zoning town, they had the same thing, right? Massive increases
Yeah.
in rents and prices coinciding with new development and then a big bust in the 80s. And people go, "Oh,
Hmm.
well, that's why prices are stable in Houston, this liberal zoning or whatever, and prices didn't rise as much in the 2000s boom. But then, of course, in the 2010s boom and recently, they have risen a lot. And so
Exactly.
it makes me think of Tokyo, another favorite example of, Tokyo zonings, why rents are flat there. I'm like, what do you mean? Tokyo had the same zoning when they were the most expensive city in the world by like multiple times, right? In the 80s. And of course, if you had once in a generation, once in a, century collapse after a property bubble, yeah, they'd probably be stable for a while, especially with deflation and all the rest that goes with it. Would you
Yeah, and
say
the fact that
Tokyo is very
Japan had
misunderstood too?
multiple recessions in the 1990s that were asynchronous with the global, or not talking Japan, asynchronous with the global economic cycle of Japan. Had the humongous collapse in 1991, and then the economy started growing again in the mid 90s and then had another recession, even though, the United States and Europe were doing well and had these fits and starts of recession and deflation followed by return to growth. And yeah, of course, that's going to be terrible for housing prices and the fact that over that whole time period, the price of housing is flat, but the price of toothpaste was also flat, that they had no inflation for 25 years. Um,
I'm gonna reply
it's,
to anytime someone says Togi, I'll be like, compare the price of toothpaste. And in fact,
yeah,
the same with the stock market in Japan as well, right? It didn't regain
it
its
took until
80s.
2024 for the Nikkei index to regain its
It's 40.
1991 peak.
So
Yeah,
we're talking 33 years, right? Wow.
yeah.
In nominal terms. So there was a
In
lot of
nominal
deflation.
terms.
Yeah. So yeah, of course, if all assets haven't reached their previous highs and are priced flat, then property is one of many alternative assets in your economy, and
Assets.
it's got to be priced consistently with those other
With the
assets, right?
large equilibrium in the broader asset market. And the fact is, I think I always talk about like people tweet at me that like, oh, well, we can certainly get, construction costs down below the marginal price of providing a home. It's like, but the marginal price or not, excuse me, we can get the marginal costs of producing the next marginal unit of home below the price in the marketplace, whether it's rent or priced or purchase price to own of a home. But that actually doesn't matter because what really matters is what is the return on investment. It's not just merely mere accounting
Mm,
profit. It has to be an economic profit of that. If I tie my money up either for 12 to
mm,
36 months to build this housing project and then sell it, or I tie my money up over the long term owning rental housing, is not just do I make an accounting profit, it's do I have a return that
mm,
compensates me enough given what I can get in the broad market for assets, um, and given the risk of owning homes or owning housing and the illiquidity of it, right? And the fact
mm,
that U.S. stock market indexes have gone up 10% a year on average, and there's no property management, there's no evicting tenants, there's no screening tenants, there's no maintenance or architectural failures, nothing. It's just own the index and you watch the price go up over time. And so,
Yeah.
yeah, of course, to own housing, people are looking at a minimum, even for an
Yeah.
acquisition, of they want 20% on their money total return. And
So you're right. Like, I guess after all these years, I've never quite articulated it the way you just did, which is that a lot of the analysis of housing markets and new development relies on this accounting profit idea. And they miss a couple of things. Firstly, the price of land will get bid up until there's essentially no economic profit, risk adjusted,
yes,
right? So,
yeah,
so in an accounting terms, yeah, you're going to get this thing left over, and you'll be like, hey, great. Like, even with the price of land, there's still this profit. And you'll be like, yes, there's still that accounting profit, but it's not economic profit because that is based on our alternative investments, including not building this dwelling this year and waiting for the next boom, right? That's another alternative that I can do. And so you go, oh, yeah, developers need a 25% margin or whatever it is, depending on the size and risk of the project in accounting terms. And I'll be like, yeah, they do, because that's the margin that equalizes the risk adjusted, right,
exactly.
economic profit across alternatives. And so, yeah, you've sort of articulated something I've spent years trying to explain better. And maybe I'll try and write it down. Maybe there's some diagrams. But I want to push on because we've agreed quite a lot, and I want to disagree. And one of the things I think we might disagree about is this new tax on property trades. Is it in Los Angeles only or all of California? Called
Los
Measure,
Angeles only.
yeah,
Measure
Measure
ULA
ULA is a new
and
tax. And
measure. Yeah,
my,
so
yeah,
so
what is
in
it? Because I think
California,
it's like a stamp duty for the Australian listeners, but maybe
yeah,
it's
yeah, yeah.
slightly different.
So I want to the numbers are where it's a tax that you pay in Los Angeles. It's called Measure ULA. LA stands for Los Angeles. I think
Hmm.
U stands for United. And it's a measure because I think a group called Los Angeles United proposed it, and in California, especially, but in some other U.S. states, that they have direct ballot measures where rather, you can have the state legislature can vote a bill and the governor can sign it, or the city council can pass an ordinance. But they have these things, these ballot measures in some states. In California, it's the easiest state in the union where you can get a ballot measure on the ballot, where the voters themselves will vote on something. And
Hmm.
so it's called Measure ULA because named after the group that sounded and it was actual the citizens of Los Angeles voted on this in 2022. It went into effect in 2023. And it was passed by quite a large margin. I think it was 55% in favor voted yes. Um, and it is a tax on any property, including multifamily housing or a warehouse or any property in the city which is sold or traded. If it's above 10 million US dollars in value, it pays 5.5%. And if it's below, if it's below that, but above, I think it's 4 million, it pays up to
5.3 million.
4%.
I've got the
Yeah,
chart up
5.3
here.
million.
Yeah.
Yeah.
It's been increased with inflation, these tax brackets. So it's 4%
Yeah,
between
exactly.
5 million and 10 million and 5%
Yep.
above 10 million.
Yep.
And it's nothing under 5 million.
Correct.
But it looks like there's a base rate of stamp duty of 0.45%. Is that right? A base rate of
Yeah, almost
tax on
every
this.
municipality
Okay.
will have in the country has
So for the
has that, and
Australian
that's a
listeners, the base rate is 0.45%. But in New South Wales, the cheapest rate is about 3.5% for any
okay.
property transaction. So above $100,000, you're paying 3.5% in New South Wales. And 5.5% is the maximum marginal rate above 1.2 million in New South Wales. So this is like a stamp duty that's much, much smaller than New South Wales one, but and only for 5 million and above. So what's happened since?
Well, I think that I got to put LA in context a little bit. So
Hmm.
LA is also a very, very, I guess California generally. I mentioned San Francisco, but again, San Francisco rents are still below or have very, if not below, they have very recently regained, as in maybe in the past month, their pre-pandemic levels.
Wow.
Right? Or they're even their 2018 levels because rents were pretty weak in 2019 as well. So rents were flat to falling very slightly in 2019. They fell dramatically in 2020. They rose dramatically in 21 and 22, but not enough to make up for the even bigger declines in 2020, and then they were basically flat going, they've kind of been flat to almost growing very slightly until very, very recently, where now they're up a lot because of the whole AI boom. Is that San
Mm.
Francisco is home to a lot of the companies that are doing this AI stuff. And so rents have finally started to grow again. Uh, when it's not just a post-pandemic, an end of pandemic bounce back, which is what 2021 and 2022 was in San Francisco and many other cities in the United States, as I pointed out. And so now
Hmm.
rents have finally regained their 2018 levels, and materials prices in the US have gone up 50%. So for people to say it's regulation stopping the building, it's like no, net operating incomes are in nominal dollars are back to 2018 levels, and material prices have risen 50%, and wages are probably up 30% in nominal terms. And so, yeah, nothing is even close to being viable financially. Um, and LA is not such an abstract extreme example. But again, it went through a very similar pattern in the rental market, where rents are up cumulatively since 2018 about 10%, and they're not rising at all because there's no AI boom in Los
Hmm.
Angeles. And in fact,
Yeah.
Hollywood is in decline because it's facing tons of competition from all these other non-studio backed places that are producing film and the equivalent of film and television, but it's on streaming services. And so you see pretty flat rents and rents that are significantly lower in real terms than they were before than they were in
Mm.
2018. And so
Wow.
it's very difficult to make housing work there. Now, everyone's saying that, the mayor and the city council are against new housing, and that's driving developers to abandon LA. But just on a, I've had several developers tell me, in private, and oh yeah, the rents just aren't high enough for it to ever make sense for us to build right now. That, we wouldn't, you know,
Mm.
we'd either be building at some we be building like a one or a break even, a 0% rental yield if we built, and then we couldn't even service our debt payments. And uh
Mm. Yeah,
so
well, of
so that's
course. I
LA.
mean, that's the normal thing in Australia. You can't pay your mortgage. On
Yeah.
That's why we don't really
And
have
and
this
so
build to
and so the
rent.
rental market the rental market has been very weak and sluggish
Mm.
in LA for the last 7 years at least, and continues to be, where rents really aren't rising. And they're not falling anymore like they did again in 2023. They fell slightly. Um, uh, so they're kind of flat. And so I think
So, are you
that
saying that with this extra 5% price tag on, I assume that's just on buying the site, right? So, if you're a developer, when you
no, it's
sell,
on the sale. It's the conveyance of value. So when you buy or you yeah, so when you buy the well, if you bought the site, you would pay the tax, yes, and then if you sold it again at the appreciated value because it has an apartment building on it, it would be paid again.
mm,
Uh, so anytime the property trades and
mm,
whatever the assessed value is, including the improvements.
mm. But for a like build to rent business who bought a site for 5 million and then built a $10 million building on it, they won't pay any on it. They'll just be renting that out.
If
It's
they
only
held through
if
the whole thing, if they built it
correct.
and then they held it afterwards,
Yeah, yeah.
um, they would pay it one time on the
Yeah, yeah, the purchase.
the 5 million, the
Correct.
purchase. Yes.
Yeah, yeah, yeah. So it's similar to our transfer tax. And
But
so
why I
so
wanted to put
you're
LA in
suggesting
context.
that because of all these conditions, adding another transfer tax is now essentially delaying or
Um,
making these
so
types
so
of projects less preferable.
so I think in the current environment, I think that LA is so I think development is so challenging. The outlook is so weak right
Oh.
now in LA that I don't think that the tax is really delaying many projects, right? And obviously, building activity never
Mm,
goes to zero,
mm,
even when the market's weak. There's always
mm.
someone building something. Maybe someone has a contrarian view. There's contrarian investors. There's people who buy stocks, which are, everyone says they're not going to do well, but they take a contrarian view and build.
Yeah.
So there's contrarian investors in the LA real estate market who say, hey, let's throw up some apartments or whatever. Um, so what I'm trying to say is that I think that the market's already pretty challenging. So it's hard to say that because of this
Mm.
tax, this new tax, that's why there's very few apartments being built. I think that the market was already pretty challenging. So that's not the claim I'm making. The
All
claim
right.
I'm making is more theoretical,
Mm-hmm.
is that, and maybe this is based on US customs or US
Mm.
industry preferences, is that the vast majority of apartment buildings which are built are sold immediately upon
Mm-hmm.
completion to another set of investors.
Mm-hmm.
And so people take a construction loan.
Yeah.
It's almost always an adjustable rate loan from where it's a 60% loan to value of what they think the value, of the final construction, the finished product is going to be. They, get 60% of that. The other 40% has to be covered from investors,
Mm-hmm.
and they will almost always try to sell immediately upon completion to another
Yeah.
set of investors who can then come in with a loan that has a higher loan to value, right? And
Yeah.
so I think the reason that is for a couple. Well, the first reason is that you have segmentation in the real estate market, that you have firms that specialize in construction and then firms that specialize in acquisitions and operating. And the other factor is that to keep a 60% loan to value adjustable rate loan is very unfavorable financing. And so in theory, and this does happen, if you can't find a buyer, you refinance. But it just, you always pay
Yeah.
fees and stuff on a refi. And so it's much cleaner to just sell, get your money back, and then go build another. And at some sort of use it like a 30 or 20 to 40% margin, and then go on to your next construction deal. Is how these firms tend to operate.
So would you say
So it's
that
actually
then
it's quite rare.
because this 5% is coming off the sale price after development,
Yes.
that's knocking out some projects from
I
the
think it could.
potential.
I think it will
Mm,
potentially in a hotter real estate market where you have,
mm,
because again, you see this from also people who in the YIMBY movement, and just commentators more generally, who say that, well, developers and landlords have divergent interests, because a developer, at least
yeah,
in the US, it's very rare for a
yeah,
developer to build
to
something and
hold.
hold it
Yeah.
as a rental property.
Hmm.
And so they say, yeah, but the thing is, if you're selling to a landlord, the landlord's not going to pay you a price that you need and get your margin if they don't think they're going to get their strong risk-adjusted return, again in equilibrium with the broader asset market. So they're very smart to know, they're sophisticated enough to know that, like, yeah, it's not like we can just, this is some hot potato that, we can just, it doesn't matter if it's actually going to make any money when we're done, when we deliver a completed project. We can just throw it off to some patsy who will buy it and we'll make our margin. That's not how it works. They're very cognizant. In fact, every single one of these firms is doing a mock underwriting of the project. So they'll say, like, with the sale in mind. So what they'll do is they'll underwrite. They're not going to hold it, but they're underwriting the sale, looking at it from the perspective
Yeah.
of the acquirer. Hey, we know what these guys are looking for in their buy box and their underwriting. let's look at what we think we can build this for, and can we come in? Can we provide a product at this price where it's going to clear those underwriting hurdles from our buyer pool that we, are obviously in constant contact with, because it's all one big industry.
Yeah.
Um,
And do
and so,
they
so that's
often
all go.
pre-sell and sort of get the construction loans up based on the pre-committed sale contracts? Like, because here
Sometimes, yes.
it's most common here that nobody starts construction unless they're either willing to hold it or have a buyer. It's almost never done except for what we call like owner builders who might just buy one block of land and build one detached house and then sell it
Okay.
after it's built at an auction. They put fancy furniture in it. But if you're building an apartment building, no one builds it unless they have a buyer. There is a guy, Harry Triggerboff, who's one of the biggest private developers, and he will build it, but he'll pre-sell 50% or 30%, being willing to own the other 70% himself.
Condominium buildings are almost, the units are all pre-sold.
Yeah.
Absolutely.
So,
And ho single family homes too. And that's not the case
but even
in,
build to rent
I mean,
to
American English
institutional
is all spec
investors,
homes.
do they even to institutional investors with a build to rent type, because you guys sort of differentiate this, right? But a rental building, would you not have an institutional buyer lined up before you commit to construction
Ideally,
typically?
yes.
Oh,
Ideally,
okay,
yes.
okay.
But sometimes it happens
Sometimes
where,
they take
where
risks.
you have, they take risks, and then
Okay.
they're trying to either, they're racing to refi, or they're racing
Uh,
to sell, because you want to get out of the 60. If you're
mm,
stuck in the 60/40, 60% LTV loan,
mm,
that's not enough, and you're building at a 3% rental yield or 4%. You're probably building it closer to a 6% rental yield and hoping to sell it to someone at
yeah,
a 4% rental yield and
yeah.
make your margin, and go on to the next deal. But like, even if you're holding at a 6% rental yield with that high loan to value,
Mm.
your returns just aren't going to be very attractive. And also, you're in an adjustable rate loan, which is risky. So, and that happened
So,
in Austin, where you had people building
uh,
with adjustable rate loans at,
mm,
0%, which is where short-term interest rates were at the time, plus 200 or 300 basis points. And when they couldn't sell, and when the Fed raised rates, the rents didn't even cover interest payments.
So would you
Um,
say your prediction for Austin is yeah, rents will fall, but then they'll stabilize and basically the construction industry is going to contract massively now as everyone
yes,
learns
and
that
it's already
their previous
happening.
bets were wrong. So
It's already
you don't think
happening.
rents will just keep falling because of YIMBYism? You think they're pretty
Well,
much done their adjustment to
what,
this?
again, once you start, there's no turning back on a lot of these
Mm,
things. So much was in the pipeline,
mm,
from 21, 22, and even into 23, that, we're still seeing a lot of new deliveries coming in, and 2025 is going to be strong is going to be, there's tons of deliveries coming in, and they
mm.
have come in and will come in this year and next year as well, but it will be lower. And 2027 is going to see almost, I'm predicting that 2027, in terms of new deliveries, you'll see under 5,000 in
Wow.
Austin, maybe less, maybe
And
2,500.
what was it, the peak deliveries?
I think 35,000.
Oh wow, okay. Yeah, so I mean, we're still building apartments that were sold off the plan, 4 or 5 years ago today, right? Like I can see them out my window here. So yeah, you're right. The pipeline is long and it's hard to change. And I think in Canada and Toronto recently, trying to settle these transactions after the building was complete, a lot of buyers would pull out, right? And forego
Yeah.
their deposits because if they've paid 100,000 deposit on $1 million apartment that's only worth 800,000, better to lose 100,000 than 200,000, right?
Yeah.
Um, or lose your 100,000 deposit and buy it back at 800,000.
Yes.
So there's one more topic I want to sort of touch on before we wrap up. We've had a pretty long conversation for my
But to
podcast, not
put a
quite a
bow on,
yeah,
yeah, to
yeah,
put a bow on the measure ULA debate, I think in the
yeah,
US at least, my big concern is that, because the business works where very few groups, you have firm specialization of, you have groups that do acquisitions,
mm,
including new construction and newly produced, things that have just come onto the market because they were just completed, and you have firms that specialize in the construction phase. Because you have that divide, I think it could be a substantial
oh,
market friction if the LA property market and rental
picks
market
up.
were strong enough to support development. It doesn't right now.
I mean, the way I would see the adjustment happening is like it does in other
Yeah,
countries
I
with large
think,
stamp
yeah,
duties, is that this all gets priced into land and priced into the type of building you build and it all gets optimized and the frequency of trades reduces because obviously people
yeah.
take this cost
So
into
yeah, so
account.
I think
And
that,
so all there's like lots of margins to adjust on.
yeah.
And it obviously takes time and the economic incidence is on certain groups and not others. So I mean,
So I agree
my
that
view
you
would
would
be,
if
how much does this affect the price of rents in LA in 10 years' time? I would say round numbers zero.
I think it is right that in the long run that yes, you would see if you had um an LA rental market that was strong enough to support a lot of new development. I think that you would see firms adapt. And this was, one report that came out that said, oh, firms are going to just change their business model and they'll just build and hold longer. You'll see more. And that's not it's not like that does not happen in the United States. It's just rare,
Mm,
right? And usually it's because something went wrong that they couldn't sell or the market deteriorated substantially during the
mm,
build and now they need to hold. But I think that firms, again, you would see properties trade less frequently, which means probably you would see more firms saying, "Hey, we're fine building and holding,
mm,
and we'll put that into our business model." And I think just the way the industry is structured right now, you would have during the adjustment period. I think it would have a bigger. It's going to have a bigger impact. Again, with the caveat, if the LA rental market were strong enough to support a lot of new development,
mm.
where when it isn't. So,
Interesting. I'll give you some perspective on the taxes on property trades. Singapore has a foreign buyer property tax of
oh,
local
it's like
buyers of
30%.
for locals of a second residential property, it's 20%. For a third property,
Wow.
it's 30%. For a foreign buyer, um, let me have a look. It's 60%. They're basically taking foreign buyers out of the market, right? It's for residential. But of course, for locals, for your first property, it's zero. So there's like
Okay.
quite a huge incentive they've built in. Um, but yeah, my last word on that is that it's quite interesting because part of the conversation in Australia about encouraging these large um, build to rent building owners of $5 to $10 million buildings is one of the sales pitches here is, oh, they don't trade very often, so tenants don't get kicked out, right? You've got one owner who's going to own it for 30 years. And one of the problems with the mum and dad landlords of housing in Australia is that they like to speculate on the market. When the property's hot, they sell it and they kick the tenants out and they make it look pretty. And so one of the main reasons that tenants move in Australia is because the landlord sells. And so one of the pitches for these institutional buyers is or institutional landlords is that they won't sell very often. So I mean, I think like all
Hmm.
things in property, there's a trade-off and we've got to know, is it worth it? So anyway, there's a meme you share, Mike, and it's got the astronaut looking at planet Earth and pointing out and says something like, wait, it was all distribution of income, wait, all housing issues are just distribution of income. What's that all about? Can you
Yeah, I just
explain it?
think
Because I got to go find it again.
so I think that it's just self-evident to me that when you have certain areas, it gets back to the location premium on land and any real estate is its location. The vast majority of the value is being derived from the locational desirability of the land. I think there's a great member of the English or British, be careful, House of Lords,
Mm,
um, and his name is Adair Turner,
yep.
and he was a financial executive for a long time, and he first came across my radar again as I was getting my start in economics because he had a lot of commentary about the great financial crisis.
That's right.
And I think that he said that the best performing asset in in history really has been locationally desirable urban land. And so you see a lot of people say, "Oh, well, stocks crush real estate in the long run," and that's true because when you say real estate, you're encompassing a humongous number of
Distribution of
potential
like, yeah,
assets.
yeah,
So,
yeah,
like, yes, land in the outback or Siberia or Yukon is probably worth the same that it was 200 years ago in real
hmm
terms, right? And
hmm
maybe even in nominal terms in some cases,
yeah,
right? That it just, land that nobody wants that's in some vast wilderness that, has no use value. I mean, most of Canada when it was British possession, there was no real exploitable natural resources, and the way the British Crown made money off is they literally just sent in hunters to go hunt animals and sell the pelts to like make
yep,
fur coats and stuff. And that was the only real value that, in like 1500 that land in Canada had to the British Empire, the English, uh, Britain
mm,
wasn't, it wasn't Britain yet, but whatever. And so yeah, and there's still parts of Canada where that's like the highest best use of the land is like hunting grounds, probably, right? And so yeah, when you say real estate, well, yeah, that land hasn't appreciated at all, but land in Vancouver or Toronto has appreciated way more than any this the Canadian stock market or the U.S. stock market or like land in Manhattan in my country, you know, Long Island. Uh, Probably was under duress, but there's a legend that Native Americans sold Long Island for $7 to
yeah,
colonists, hundreds of years ago, and obviously like the greatest trade of all time, right? Um, and so yeah, so locationally desirable urban land is just incredibly well-performing asset because societies have become more agglomerated and more urban. And so I just think that, in any property market, yeah, you're going to have any locationally desirable areas, be it where only the highest income earners can afford to live there. And that's the way any private property market is always going to work. And it doesn't like,
you
I
don't see any
don't
way
really.
that that couldn't be true.
Well, I mean, again, it gets back to where you can build the higher density, but
Mm.
that runs up against the fact that higher density comes with higher costs of construction.
Yeah, and it's not like it's exactly the cheapest place to live per square feet in high density
Yeah, I
locations,
like
right?
made this thing
Like,
like, what if you? I think if I said like I've used this thought experiment, this hypothetical that like let's say we wanted to allow 1 billion people to live in Manhattan. Um, and you'd say, oh, but all we have to do is provide more housing and it's possible. Well, yeah, if you could build skyscrapers that go into space, maybe theoretically you could build enough housing where that would be possible. However, what would the rents in those apartments have to be? Because like
yeah.
you somehow invent the technology to be able to go into space. You're paying astronauts hundreds of thousands or maybe millions of dollars a year to build the units. You have to pump oxygen up into them. How much is the elevator? The elevator is like the big on any apartment building or any condominium building, the biggest piece of maintenance is the elevator. They're incredibly expensive. It's like, I mean,
Yeah.
how much is the elevator on one of those things that costs? Like, I mean, the rents would have to be, you could, in theory, to get that much housing to fit in Manhattan, you would have to do something like this, but the rents
But
for
that would
those
only
apartments
work
would
if
have,
the prices were high enough.
if the prices were
Right.
high and if people were willing to pay $1 million
Because
a month in
actually it's
rent
the
or something, and
price that's rationing who
yeah,
can move there, right?
yeah.
Yeah,
And the price would still
interesting.
ration who could move there because if you,
Exactly.
uh, and so
So
yeah, so that's,
it's funny you use that example because do you know Tom Davidoff at UBC? He's an economist, academic. He's got this paper of like, what if what if we built um, what if we built to the limit in Manhattan, right? How cheap would it get? And he basically says it wouldn't get cheap because people would move there, right? Because if it was cheaper than what it
yeah,
was now, then someone would move there because it would make sense for them. And he sort of makes the case that, even if we had two or three, four times as many dwellings, the price wouldn't change much because it would predominantly
yeah,
just shift people in. And of course, even
And
yeah, and if prices did fall, then smaller buildings would make sense, not larger
And
ones.
I think that that also just like the fact that Manhattan itself is like, I mean, New York City is built one of the highest cost places in the United
That's
States, and
true.
also where rents are substantially higher now than even before the pandemic, but there's still not that much building. It's because cost to build have risen more, but it's still humongously below its
Mm.
maximum allowable density, even under current zoning rules. And so the
Yeah.
question is, why aren't they building? Why aren't they building? If regulations are stopping these projects from going forward, why aren't they building more? People say, oh yeah, Manhattan is dense, but there's way more building that could happen in Manhattan. And that's absolutely true, but it's because the returns that you could
Mm.
get based on current market conditions aren't there. And when you actually do the math and say, what's the cost for me to acquire this property, to kick out all the tenants, to tear it down, to build something denser? You say, oh, well, yeah, no, it's actually my returns would be higher if I just bought the apartment building and just kept the tenants in there and kept collecting the rents,
Mm.
right?
Yeah.
So it's actually the economics are just, that's the optimal investment decision is to not build anything. And yeah, theoretically you could under the rules, but it would make no sense because you'd be foregoing, 2 to 3 years of income and then taking a lot of risk, construction risk and all this stuff to maybe get
Yeah.
a slightly higher, a higher rent, 3 to 4
You're
years from now.
you're making that accounting versus economic profit case again. That yes,
Yeah.
redevelopment might be now, but in terms of what I'm giving up economically and the opportunity to do it in the future, it doesn't make sense right now. And that's obviously, everything's constrained economically. People don't do things that's not their best choice out of all the alternatives.
Yeah.
Um, Again, articulated in a very good way. So if I was to ask you, Mike, I believe you, it's all about the investment conditions, but what can we do to make the cost of housing lower? From what I'm hearing, the market's doing what the market does. And it's sort of funny because I reluctantly had to come to that conclusion after many years also looking at the
So,
housing market, that this is what the market does. So, if you were the king of California, um, Measure ULA doesn't sound like it's the top of your list, but whatever. Um, People are still upset about rents, even though they're nominally roughly where they were 6 years ago. Some people still want it cheaper. I mean, firstly, do you believe that the average person wants rents and prices to be lower or compared to higher? And secondly, if we took as given that people did, is there a policy sort of direction you would be looking at?
I think that, and this, draws a lot of ire from a lot of the YIMBY movement, but I think government backed financing or tax incentives in exchange for affordable units is the best solution out there, or one of the best.
So
And so
essentially,
one
you're
idea,
saying buy new subsidized units with tax in some way by giving a subsidy for a payment, like
either a subsidy or
tax
a
break or
loan, a tax break, or some sort of loan on very favorable circumstance, conditions that don't exist in the
Mhm.
private market because and so if so for one example, mezzanine debt uh, for uh, new construction that's backed by the U.S. government. Uh, so there's no credit risk for the lender
Mhm.
that could substantially lower borrowing costs during the construction phase and allow for more leverage to put up these buildings where you could actually accept the project itself could the total returns to the whole project could be lower and then the actual equity slice would make a higher
Mm.
return so that investors actually could build affordable units that are no more than some that rent for no more than some percentage of the mean income of the area. You could make that pencil out with those kinds of incentives. But I mean, a lot of in the EMB movement that they snap back, that they say, oh, well, we shouldn't put any restriction on, the rents that can be charged because that's just going to restrict the number of total units that get built. Well, yeah, I mean, yeah, we could subsidize builders even more, but we actually do want to make sure that some of the benefits are going to the public and not just, feeding the bottom lines of large property developers. Not that I don't think that they're like evil people deserving of scorn or
Mm.
anything like that, but it's just if we're gonna, use public resources for something, I think the public should largely benefit.
Yeah, that makes sense. And as a final sort of political question, you started off with the story of the Obama years and the post-financial crisis, saying back then we wanted prices to go up, not down.
Yeah.
Would you still say that's the case? It's just that because of these distributional issues in the post-COVID era, that certain groups feel like they missed out on the chance to be in the club of winners?
Oh,
Or do you
absolutely.
think
That
there's actually enough political sort of change that lower prices sell? Because New Zealand prices are falling,
I
Canadian prices are falling, and people are suddenly shifting to actually no, we wanted higher
Yeah.
prices.
No, I don't think it would last very long if you saw
Okay.
prices fall. So I think politically, especially because, falling asset prices is not usually correlated with the strong economy, right? So, no, I think if we don't see like, oh, well, I hope stock prices fall so I can invest at a lower basis so I make more money when they go up again. I think that would, I don't think a government could ever, a democratically elected or non-democratically elected
Yeah.
government would ever try to engineer that because they'd be harming the incumbents, asset owners so
Mm.
much. And so it is a political issue that's based on unequal distribution. I can say from the Puerto Rican experience, which Puerto Rico, U.S. territory, but saw a large economic decline from the time of the Great Recession up until around 2020. And so the recession here hit incredibly hard for a variety of reasons that we don't need to get into, but you saw a huge decline in property values, where property
Hmm.
values didn't regain their 2007 peak. So pre-Great Financial Crisis crash um,
Hmm.
here until around 2023. So a
Mm.
huge period. And there's people who are upset that are saying that so prices here in nominal terms are slightly above where they were in their peak, over 15 years ago.
Wow.
And so there are people here who are younger who are upset, who are saying, I didn't get the chance to buy at the rock bottom prices in like 20, the bottom of the housing market here was around 2019, was
Hmm.
roughly the bottom of the housing market. And they're upset because they're saying, well, home prices are out of control because, I didn't get a chance to buy at the bargain basement level prices in 2019. But, if you talk to someone who bought in 2006 and they've just regained, their house is worth a tiny amount more what they paid for it almost
Mm.
20 years ago and worth 50% less in real terms.
Yeah.
Like they're like, I'm really mad that home prices fell so much and I had to, you know. And so yeah, it is the politics are gonna it's gonna I think that the politics are, you know, some of these complaints are absolutely political that you have,
Mm.
in any sort of private market, asset market, you're going to have winners and losers. And it's going to be because we have, a lot of inequality in society. It's unfortunate that these that exists and that it creates these political tensions. But the way to solve that is not to necessarily intervene in the housing market. The way to solve that might just be to have more redistribution built into the tax system generally, the
Mm.
tax and benefit system, if you want to address inequality, rather than think you can engineer it through the housing market.
Yeah, I think that's fair. That's definitely a fair case. I mean, the argument against that would be that you can make it slightly more equal, but there'll still be this sort of risk of tenants being forced to move every time the landlord sells and being exposed to the market. And there's some kind of like
Yeah, no, no, I can
risk
agree with
value
that.
from providing stability in housing either directly with public housing or with other sort of non-market provisions
I
that
think that's fair.
yeah.
I think
So
that's
that,
fair. And I
but
think a public option, like a public option in housing, I mean, the United States, we moved away from the public housing model because it's not all sunshine and daisies. There's tremendous challenges with operating public housing. And, governments tended to be poor landlords, and some of the worst landlords in the United States are governments in some
mm,
cases. I'm not saying you can't create a better model, and that can't be improved. But I mean, the reason why they moved away, again, the reason why it was there used to be a lot more public housing in the United States. Puerto Rico is one of the few places in the United States that still has a substantial amount of public housing.
mhm.
But yeah, they moved away from the model because of just, there tends to be lots of challenges with it.
Yeah,
So
yeah. It's not easy, and I think that's the catch. I don't think any sort of improvement is easy, right? Like redistribution of income creates winners and losers. Getting directly involved in the housing market needs public capabilities. But I think it's, whatever we do, I think we should, at least our conversation should be informed about how property markets work. And so I really
yes.
appreciate your time, Mike, coming on today and sort of giving your perspective as someone, who's really good at pricing assets and understanding property deals. Where should people find your commentary? Is Twitter/X the best place to read your thoughts on housing?
That's the best place to, and just at Mike Fellman is just my name. No
Perfect. You got
dash,
the.
no space.
Oh, that's brilliant.
Yep.
Yeah.
For
Well,
my Gmail account, I missed out. There's someone else took the email address mikefellman@gmail.com. But for Twitter, I got the Twitter handle. So
oh, good on you. I highly recommend everyone follow Mike's commentary. Very informative on housing, and I appreciate your time, Mike. Thanks very much.
thanks.